In every financial cycle, investors ask the wrong question. They ask, what will go up the most? History asks a different one. What survives when the system changes? In 2026, we are not choosing between stocks or crypto. We are choosing between forms of value, each tied to a different future. Gold represents trust collapse. Silver represents system stress. Copper represents industrial power. And here was the uncomfortable truth. You don't invest in metals to beat the market. You invest in metals when the market itself becomes uncertain. This episode is not about predictions. It's about positioning. Because every major financial transition, from the end of the gold standard to the rise of fiat currencies to the industrialization of Asia, left clear signals in metals before the headlines appeared. By the time everyone agrees on the narrative, the opportunity is already gone. So the real question for 2026 isn't which metal will perform best, it's which future are you preparing for. To understand where to invest in 2026, we have to understand why metals exist in portfolios at all. Metals are not assets of growth, they are assets of transition. Gold, the asset of lost trust. Gold has one primary function across history. It is not productivity. It is not innovation. It is insurance against failure. When empires weakened, gold didn't create wealth, it preserved it. During the collapse of the Roman Empire, gold outlasted currencies. During the Great Depression, gold preserved purchasing power. When the Bretton Woods system ended in 1971, gold began a decade-long repricing. Gold rises when confidence in institutions falls, currencies lose credibility, debt becomes unmanageable. In the 2020s, global debt reached levels that historically precede monetary restructuring. Gold does not predict collapse, it reflects distrust. Silver, the metal caught between worlds. Silver is neither purely monetary nor purely industrial. That is its strength and its weakness. Historically, silver functioned as money for ordinary people. Gold was held by states and elites. Silver collapses during liquidity crises, then explodes when stability returns. Why? Because silver is consumed. Electronics, solar panels, medical devices. Once used, silver is often unrecoverable. This creates structural supply pressure over time. Silver does not move first, it moves violently later. Copper, the metal that never lies. Copper does not care about inflation narratives. Copper cares about construction, electrification, infrastructure, industrial expansion. Every modern economy is built on copper. Power grids, electric vehicles, data centers, renewable energy. Historically, copper prices rise before economic expansion becomes visible in GDP data. That's why copper is called the metal with a PhD in economics, the modern parallel. 2026 sits at a crossroads. High debt, energy transition, supply chain re-regionalization, geopolitical fragmentation. Each metal responds differently, and that's where most investors make a mistake. Here's the twist most investors miss. You're not choosing between metals, you are choosing between outcomes. Gold does well when policy fails, copper does well when policy works. Silver does well when the system is stressed but survives. You cannot maximize all three, and that's the uncomfortable part, because metals don't compete with each other. They compete with narratives. So the real cliffhanger question becomes, what kind of 2026 are we actually heading into? To answer that, we need to look at how each metal behaves under pressure, not in theory, but in real financial mechanics. Gold mechanics, why gold moves slowly. Then all at once. Gold is dominated by central banks, sovereign reserves, and long-term holders. Gold does not trade on emotion, it trades on policy failure. When real interest rates fall below zero, gold becomes competitive. When currencies are debased quietly, gold responds quietly, at first. Gold's biggest moves historically occurred after confidence broke, not before. Gold is not a trade, it's a position. Silver mechanics, the most misunderstood. Metal. Silver markets are dominated by paper contracts. For every ounce of physical silver, multiple claims exist. This works until delivery stress appears. Silver volatility is not speculation, it's structural leverage. When investment demand rises, even slightly, silver supply cannot respond quickly. This creates sharp spikes, deep corrections, and emotional trading. Silver rewards patience, not timing. Copper mechanics, the infrastructure. Bet. Copper demand is driven by electrification, grid expansion, EV adoption, and data infrastructure. Copper supply is constrained by long mine development cycles, declining ore grades, and geopolitical risk. Copper does not explode upward. It grinds higher. Then shortages appear suddenly. Copper investors are betting on real economic activity, not monetary narratives. Comparing the three, reality check. Metal wins. When loses. When gold trust breaks. Growth accelerates, silver system strained. Oh, liquidity, tight copper. Industry expands, recession hits. This is not opinion. This is historical behavior. The portfolio truth. No one likes. The best investors, Dante, ask, what is the best metal? They ask, what mix survives multiple futures? That's not exciting. It's effective. 2026 will not reward certainty. It will reward resilience. Gold is not about profit. It's about protection. Silver is not about speculation. It's about stress. Copper is not about fear. It's about progress. If you put everything into one narrative, you're betting against history. Because history doesn't choose one outcome. It chooses complexity. The question isn't IT where to invest in 2026. The question is whether your portfolio can survive being wrong. If you want more financial history explained without hype, subscribe. This channel doesn't tell you what to buy. It teaches you how systems behave.